I'm Miles Stouty. I'm the portfolio manager for the fund, as well as being a director with Jonathan, Chris, and Jeff. We also have here today the boss, Emma Davidson, and portfolio manager Mark Ambrose, our new senior hire. The three of us are joining from London, where we don't want to be, and it's a bit dark, a bit wet, and just generally a bit unpleasant as always. We were due to be out in Australia at this time, which is a bit unfortunate. We had to postpone that with the lockdowns several months ago, but we are due to be out soon. So the plan at the moment is to be out for all of March, maybe a little bit of April, and we'd love to see as many of you as we can when we get out there. In terms of this presentation today, Emma's going to start off with an update on the company. I'll then provide some thoughts to the best I can on the big picture and what we're seeing in the portfolio at the moment. And then Mark is going to talk a little bit about the private equity theme. He gave us an update on this, or sort of introduced us to this in May of this year, and it's become a really important part of our portfolio. So we thought that'd be a really interesting thing to do. And then just before we get on to the Q&A session at the end, Emma and I are going to give a little update on the investment manager, Stated Capital, and then as always, we'll do our Q&A. There's been a number of questions that have come through in advance, and we're obviously, so we'll answer those, and we're obviously happy to answer any questions that come through as we go through the presentation. I think Jonathan explained earlier how to use the chat function, but just briefly, what you're looking for is, do we have the slide up for the?
Sure, of course.
What you're looking for is there's a chat icon at the bottom of your screen. I think by now we're all old hats at Zoom, but for those that haven't done it before, there's a chat icon at the bottom of Zoom, and you want to click on that and write your question in the white text box, and we will certainly come back to everyone. And on that, maybe I'll let you start off, Emma.
Thanks, Miles, and hello, everyone. To start off today, and given it's our morning over here on the 11th of November, I did just want to take a moment to remember and give thanks to all of those who've come before us. Miles, Mark, and I are wearing our poppies today, and just wanted to commemorate those people. Otherwise, it's so good to see so many familiar faces and see so many familiar names on the screen. We've missed everybody very much these last 2 years. As Miles said, I'm going to spend just several minutes talking about the company. GVF is in great shape. FY 2021 was an extraordinary year for the company, with total shareholder returns over 32%. I think Miles's letter in the annual report covered off FY 2021 in great detail. And the team also shared with us 5 recent case studies, which hopefully provide investors with some great insights into the portfolio. As well as the detail in the annual report, we also did a 4-minute video summary of FY 2021, which you can find on the homepage of the GVF website. For today, though, I thought I might just talk about where the company stands and what we might be able to expect over the coming months and the coming years. Now, many of you know GVF, but for those of you who've joined us recently, or those of you who could just do with a quick reminder, I will spend a moment talking about who we are and what we're doing for you, our investors. Now, we have a very differentiated strategy at GVF. We're not stock pickers. Instead, our core skill set is an ability to unlock value from investments in our portfolio through a variety of hands-on techniques, the most obvious one being shareholder activism. Our stated aim at the Global Value Fund is to target share market-like returns, but to do so with a much lower risk profile than a portfolio of international shares. Essentially, we're aiming to be the steady Eddie in your portfolio. What we're looking to provide investors with is 2 sources of return. First, the source of return that comes from the underlying assets that we've purchased at a discount. And then second, the returns that we make by unlocking the discounts that we've purchased those assets at. And the way we achieve that lowered risk profile and that first source of returns is through diversification. Now, most of you will be familiar with the 2 pie charts that we update every month in our monthly, but if not, here is how they break down. Starting with the assets, on a see-through basis, GVF typically is only ever partly invested in equities. As you can see here, listed equity forms 40%. We then hold listed debt. We then have some listed private equity and some listed hedge funds and so on. Typically, we're only invested, as I said, partly in global equities. By investing globally, we also end up holding a basket of currencies. But again, our entire philosophy here is about driving risk down through diversification. And the basket of currencies we hold largely reflects the global investable universe. So we have a large US dollar exposure. We then have some euros, and then we'll have a large Aussie dollar exposure. Now, the Aussie dollar for an Aussie dollar denominated company like GVF is the lowest risk currency for us to hold, hence its large presence. Now, on its own, this underlying portfolio of assets on the left and the currencies on the right is a unique and conservative portfolio, and the returns from these make that first source of return that I referred to earlier. So just to be clear, if we take the assets and the currencies we've held over the life of GVF and we attribute those returns out in graphical form, they look like this. The dark gray there at the bottom represents the underlying assets that we've just run through. Then there's a light gray on top, which illustrates the returns generated from the basket of currencies that we held. And as you can see, this is the basket of assets and currencies has produced a conservative rate of return of around 6% per annum. And that's what we would expect: low risk, low return. The way GVF then targets higher returns in spite of this low risk portfolio is to strap on top all of the discounts that we unlock doing what we do around the world. And this is that second source of returns. This top navy line shows GVF's net after all fees and costs investment returns. And the line hopefully illustrates the market outperformance that I believe we have delivered through time. Since launch, GVF's annualized net returns have been close to 11% per annum, and that's a result that's been achieved on that much lower risk profile that I was referring to. Now, probably the most important tool that we use to ensure that shareholders directly participate in the returns that we have generated is that we aim to pay out all of the returns back to shareholders over time as franked dividends. Now, this slide shows all the dividends we've paid out since IPO, and it hopefully shows that consistency and reliability of the 8 to 9 cent grossed up dividend stream. Since IPO, investors have received back 56 cents in value on their initial $1 investment. On top of this, and after the payment that hit our accounts on the Monday just gone, our profits reserve sit at 21.5 cents. So the next 3.5 years of dividends at that current dividend payout rate tucked away for the future. Now, a question that came in from John Thompson ahead of this presentation was, you say that the reserve can sustain the current dividend of 3.5 years, but is that true of the franking balance, or could some dividends be less than 100% franked? I thought I might answer this question for you here, if you don't mind, John. And the short answer is yes, it is possible that some of our dividends might have to be partially franked. We have had to do this once or twice in the past, and this is because GVF is a company that invests internationally. So collecting franking from the income of our underlying investments is quite rare. You only get that franking if you invest in Australian assets, and we're obviously investing around the world. The majority of our franking that GVF collects is from the tax that the company is paying on everyone's behalf at the company level. If it does get to the point where we have to partially frank a dividend, what we've tended to do as a company is top up the dividend element so that the total grossed up dividend remains steady state. Anyway, I hope that answers your question, John, but do drop me a line if not. GVF has started FY 2022 off well. The portfolio is up 6% in the first 4 months of the year. And we will continue to stick to our knitting of protecting shareholder capital with ruthless risk management while maintaining that semi-annual consistent dividend of 9 cents grossed up. Just one more graph from me, if you'll indulge me. And this is a graph that shows every single investment that GVF has ever made and the profit or loss on every single one of those trades. And I always love this graph because, in my opinion, it tangibly proves that point of a skewed risk profile. In other words, our very high win-loss to loss ratio. I'll hand over to Miles now to give us an update on the market and the portfolio.
Thanks, Emma. Thank you. And I love seeing that chart. I haven't seen it updated in a while. That's quite nice. Look, as always, I'll start off doing my best just to say a few words on the big picture, and then I'll talk a little bit about what we're seeing in our portfolio today. As Emma said, we put a lot of work into the annual report letter, so there's a lot of detailed case studies in that. We didn't think we'd sort of rehash that, but rather more productive would be looking ahead. What are we seeing out into the future? But just starting with the market and maybe starting with an observation. We are a year and a half now into this arrival of COVID-19 into our lives, the worst global health crisis in a century, a disease that's killed 20 million people. Here in the developed world, it's completely upended our normal lives. We're all horrendously frustrated with it all. In the developing world, it's pushed something like 120 million people back below the poverty line. Yet, if you're an investor in just about anything other than cash during this period, it's probably been one of the best investment periods of your life. And that disconnect between the real world and the investment world is something I think is just worth touching on for a minute. The driving force behind all of this, behind all of the wonderful gains we've been making recently, whether it's Australian property or share markets or even new asset classes like Bitcoin, the driving force behind all of that has been the falling cost of money. Money today is cheaper than it's ever been. There are enormous amounts of it sloshing around the system just trying to find a home. And more than anything, that's what's been pushing asset prices higher since the pandemic began. And while that dynamic's been really pronounced for the last, say, year and a half, it's something that investors have enjoyed now for a good 30 years. We've all enjoyed this steady drumbeat of interest rates falling lower and lower, pushing asset prices higher and higher. And hopefully that's something I can actually illustrate on this chart.
Yes.
The navy line on this chart, there we go. The navy line on this chart shows the yield on the US 10-year government bonds. It's a key interest rate benchmark all around the world. You can see that follows a pretty sharp line from the top left down to the bottom right. While the grey line here shows the cyclically adjusted price to earnings ratio. This is a grey line now of the price to earnings ratio of the S&P 500. You can pop the grey line.
Yeah.
Right, there we are. The navy line essentially shows how cheap or expensive money is around the world. The blue line shows how cheap or expensive money is effectively, while the grey line shows how much people are willing to pay for future company earnings. We're taking a bit of smoothing out. There have been a few hiccups along the road, obviously. We had the dot-com bubble in the early noughties where valuations shot very high for a short period of time and then rather spectacularly unwound. And then more recently, the two big market corrections we've had, the GFC and the pandemic crash last year. During those periods, for in the scheme of things, for very relatively short period of time, valuations fell down briefly. But if you kind of look through those three bubbles, you can see a pretty lockstep relationship. As the cost of money has fallen, the value of asset prices have risen. And that is a truism of finance. So, as the cost of money falls, how much you can pay for assets by definition increases. We've all benefited from this for so long now. It's probably a bit hard to imagine a world where asset prices don't just always go up, even after we've had things like a devastating pandemic. Obviously, the inverse of this relationship holds true. Asset prices fall when the cost of money starts to rise. Now, if you wanted to make a rather scary picture about the outlook, and it's a narrative that you do hear in the market from time to time, you can make an argument, that we've hit the end of the road of this free ride, this big tailwind we've had for the last 30 years. Interest rates today have to be kind of as low as they can go. Governments just can't afford to keep spending money on stimulus the way they have been through the pandemic. The taps have to be turned off at some point. And most worryingly, we're probably all seeing some signs of inflation, possibly even high inflation, creep into the system, which is, of course, the sort of thing that gets central banks lifting interest rates again. That doom and gloom argument certainly exists, and it's something we have to keep a real eye on. We're probably not as pessimistic about as that, but I guess I'd say we do have a few concerns. They're a little bit more subtle, however. The first is, when we look at the world today and the big inflation debate that's raging on, it's really a debate about whether this uptick we've seen in inflation is a sustainable thing or whether it's transitory. In truth, nobody knows. If we were forced to make a bet, we'd probably say it's a little bit of both. meaning that it's probably the case if inflation falls back down a little bit, and that probably means interest rates can continue to bumble along right at the bottom there, their ranges where they are now. But that's a really important assumption, however. You need interest rates to stay at these all-time low levels today just to justify where asset prices are trading, just to justify the big gains we've had in recent years. And what worries us as well, that's probably the case. It's certainly not definitely the case. And there's a really nasty negative skew in that relationship. Just for markets to hold on to the gains they've had recently, sort of everything has to go right. Central banks have to do a very delicate act over the next year or two, manage an uptick in inflation while still keeping interest rates very low. If they're not able to pull that off, that's certainly a possibility. You know, where we'll probably be surprised is that interest rates shoot higher than we've all been expecting, and that would almost certainly lead to a pretty nasty pullback in the market. We don't think that correction is the most likely path ahead of us, but there's not a lot to like about that bet. Sort of everything has to go right just to hold on to where we are now. That's not a particularly comfortable place to be. While we don't think big corrections, you know, the most plausible path for the few years ahead, our second concern, and again, this is probably a bit more subtle, really revolves around investors' expectations. Over the very long run, you know, the time that horizons you really need to measure things properly, global share markets, global equity markets have generated annualized returns in the order of 7 or 8%. And that's sort of a good rule of thumb to use when you're doing your own asset allocation with your own portfolio. In the last 4 or 5 years, global share markets have generated nearly double that, you know, 15+% per annum every year for the last 4 or 5 years. And unsurprisingly, during this period of sort of above trend returns, investors' expectations have been ratcheting up. You can see that in the survey data. We certainly see that in the conversations we have with investors. And unfortunately, just because recent returns have been really strong, that's not a particularly robust platform to forecast future returns on. Indeed, finance theory tells us, to the extent that these things are useful, the lower interest rates are, the lower your expected return should be across all asset classes. To say another way, for share markets to continue compounding away at 15% a year, every year forever, would need some sort of wholesale rewriting of what we understand about economics and finance, which you know, it seems like a tall order. So why does that matter? Well, for 2 reasons. Firstly, you know, as investors' expectations get ratcheted up, they generally take on more risk, and that worries us, mainly for those investors that possibly taking risks that they haven't quite fully thought through or appreciated. And then secondly, just to the stability of the market as a whole, you know, as a general comment, without trying to sound like too much of an old fuddy-duddy, it's probably been a bit too easy for a bit too long for people to make money in the market, just sitting there for some time now. And when you take that as take that proposition at a time when markets near their all-time highs, that's perhaps not the most comfortable place to be. None of that's to say we've suddenly become massively bearish in the market. Rather, I think from our point of view, it just means that we're tempering down our expectations about what we should expect from market returns. That's one part of our portfolio. And we certainly expect them to be a bit more subdued over the next few years than we've realised in the past few years. Helpfully, pleasingly for GVF, that's only one part of what we do and probably a smaller part of what we do. It's very much a secondary concern. We have the second source of return, the unlocking of the value. That's the key premise of our fund. And on that, I might jump to the next slide.
Sure. So first line.
Yeah, not quite. Yeah, so look, as I was saying, so obviously 2 parts of our proposition. There's the returns we get from the underlying market. We run a very conservative portfolio deliberately, so we don't expect a lot of returns from our underlying portfolio. On top of that, and more importantly, is all the returns we generate from unlocking the value in what we do. And pleasingly, we're still fully invested, even using a little bit of leverage, still finding lots and lots of exciting things to do. Just to maybe frame the situation for us quickly. Last year, we had a big event in the market, big crash around the arrival of the COVID-19 pandemic. And for us in our little sort of small universe, it was basically a big dislocation event. It opened up this enormous array of new opportunities for us, fantastic arrival of trades that we hadn't found for a long time, and trades that we were putting on with much, much higher return targets than we normally expect. We have been very busily harvesting all of that value on behalf of shareholders for the last 1.5 years now. It's been a terrific run of performance. You know, touch wood, we've now done 19 months in a row without a down month. What I wanted to say is that, you know, through that time, the opportunity set has begun to normalize. So things are not as exciting today as they were a year ago. we estimate they're still a good 20 to 30% better than they were pre-March of last year. So it's still a better environment overall for us to be playing with, but things are coming back down to normal. And we would expect that. We witnessed that investing through the GFC 2008, 9 and 10, and we're sort of seeing that same trajectory today. We are still finding really exciting things, and above average exciting things, but we're having to look a bit harder, and they're generally into a more illiquid names or names that are a lot more complicated, more complex, where we have to really roll our sleeves up and dig into them. One simple way to show that, hopefully, is these charts that we're going to put on screen now. The data we're about to look at is just for the UK market. So this is one of many markets we invest in around the world. The data in the UK is probably the best, and it's certainly the easiest to work with quickly. So that's why we've just used UK data for this presentation. But I guess the comment to remember is the shape of these charts is essentially the same, no matter if you're looking at Singapore, Canada, or Australia, or wherever else we invest around the world. The first line here shows the average discount on the closed-end fund universe in the UK. So that's a key sort of stomping ground for us, key place that we play around in. You can see that it spiked down sharply during the COVID sell-off. The whole universe just became incredibly cheap for a short period of time, and we were really spoiled for choice in terms of trying to find opportunities. Since then, it's moved back higher, and today we're probably not that far off from where we were before COVID arose. The problem with looking at charts like this, and I know a lot of people in the market do, is that looking at an average can be very misleading. We don't invest into average assets. We're small, we're nimble, and our whole philosophy is cherry picking the most exciting things in the universe, not just only having a large amount of assets and just owning the average asset or owning the index, say. The second lines here show a one standard deviation around the mean. They essentially show the dispersion of outcomes, or how the range of discounts out there has widened considerably since COVID. You can see those bands were much tighter than they are pre-COVID than they are today. And that chimes very much with how we're seeing markets. While things have begun to normalize, and we are having to look a bit harder to find the really exceptional opportunities, in that bottom right-hand corner, there's still lots of exciting things to do. We're still finding, discounts on assets or funds at, 20% level, as opposed to, say, a 14 or 15 that we might have expected 2 years ago. So on top of the fact that we're still benefiting from the upheaval and the dislocation from the correction last year, we're finding other really important thematics as well. One of them is this private equity thing, which Mark's going to talk about in a little bit. And as always, and it's a thing we don't talk about too much because it's sort of our proprietary IP, but our trading business just rolls on through time. That hasn't really been affected by any of the COVID iterations, and we're still finding really interesting things to do there. I might just finish and say, look, the opportunity set will normalize at some point. I guess we've been guilty of, maybe not guilty is not the right word, but we've been very keen to highlight to everyone for the last 2 years that it's been an extraordinary time for us, and that we were really excited about what was going on. Probably by this time next year, we'll be getting on the phone and saying things are just back to normal or back to average. We're certainly not going to be packing up and going home at that point. Before the arrival of COVID, we'd run GVF for 6 years. And it was probably quite a tough time to have launched a fund. Like in hindsight, we launched GVF in 2014. All of the really juicy value from the GFC had been squeezed out of all the markets that we play around in. And since 2014 through to the start of last year, 2020, it was a pretty thin environment if you were just looking at those averages, or if you had a lot of money trying to put to work in the universe. Despite that, we've generated in the order of 7% a year of outperformance, so 7% on top of the market returns we get. And then, of course, since, if we were to include the period since March of last year, when the opportunity sets really opened up for us, that outperformance number rises to about 9. So whilst we've had a wonderful run, things will normalize, and that's not going to stop us being hopefully very excited about what we do and finding interesting opportunities for all of our investors. And I might leave that as a segue for Mark.
Mark.
Okay, thank you, Miles, and good afternoon to everyone. So some of you will have seen our webinar back in May, where we talked about an investment theme we thought was interesting and which GVF was taking advantage of. And at that time, we said we'd provide an update on how it played out. So we just wanted to take the opportunity today to do that. And just to say, actually, if by any chance you missed that presentation and would like to see it in full, there's a copy of it on the GVF website where it's currently on the homepage. So for those that didn't see it, what this theme was taking advantage of was a timing lag between what listed equity markets have done and what listed private equity funds report a lag that we don't think the market fully prices in. GVF invested in this via UK listed private equity funds. And this is a very well established sector in the UK stock market. There are around 15 companies, most of which have been around for more than 10 years. And it includes several large liquid companies with market caps well in excess of $1 billion US dollars. Now, a number of the companies in this sector are fund of funds, which means they hold a highly diversified portfolio with investments in lots of underlying private equity funds, managed by firms you may have heard of, the likes of KKR, Blackstone, Apollo, or leading venture capital firms that were the early stage investors in the likes of Facebook or Twitter. Now, over a very long time frame, we expect private equity to perform like listed equity. It is, after all, equity in private companies that face the same economic drivers as their listed counterparts. And in fact, you can see on this graph that taking 3 of the best known private equity funds over here, these have historically outperformed public equity markets over a reasonably long time frame. Now, just as an aside, actually, when we refer to listed equity markets, we're using the Russell 2000 here to represent these. And the Russell is a well-known index of mid-sized companies in the US, and it's more representative of the kind of companies private equity funds invest in. So that's the long-term picture. However, in the short term, there can be an interesting lag effect, we find. And there are 2 parts to this. The first and simplest to see is a simple timing lag. Generally speaking, private equity funds report on a quarterly basis, but it takes 2 to 3 months to publish these numbers. However, the listed funds that own private equity have to report NTAs to the market in the meantime, and often on a monthly basis. So what they do is report them based purely on what they know at the time, which can mean that the data is several months old. And as an example of this, most of the UK listed private equity funds, they've reported September NTAs, but these are almost entirely based on their end of June valuations. So the second thing is that we believe there could be a longer lag effect after particularly strong equity market performance. And this reflects private equity managers just being cautious in marking up their valuations. Combining both of these, the overall lag effect embedded in listed private equity, in effect, means you can sometimes invest in the market today, but at a level where the share market was several months ago. And this is what we did for GVF beginning at the start of the year. At various points this year, we've been able to buy into funds where we saw their real discounts to asset backing as high as 30% plus. And that's much wider than the actual reported discounts you saw at the time. Now, back in May, we highlighted 3 funds that, despite outperforming over the long term, as we showed in that first chart, had NTAs that have failed to keep pace with the listed equity markets over the more recent past. And in this next chart, if you look at where the red line is, you'll see a notable gap in performance between the listed equity markets, which is the dotted line at the top, and the funds. In fact, the funds had around 20 to 30 percentage points of underperformance versus the listed market, which had a phenomenal 6 months. What we expected to happen was that over the next 6 months to a year, the strong performance of equity markets would fully feed into the NTAs for these companies. And on the flip side, what we liked about these investments was that if global markets sold off, this lag would instead be a margin of safety, and their NTAs fall much less than the market. So just moving forward in time to the right of that red dotted line, we can see that the NTAs have since caught up, and in some cases overtaken listed markets as the final Q1 and Q2 private equity marks fed into the NTAs. Now for Q3, listed equity markets were down, and in the case of the Russell 2000, in US dollar terms, down 4%. However, and this supports the theory we've had about longer lags, the major US listed private equity managers recently announced their quarterly results. And in these, they provide some data on how the private equity funds they manage have performed. And what that gives us is a sample of the wider wider private equity market has done. What we've seen there, in contrast to listed equity markets, is consistent 5 to 10% gains over the quarter. So we're therefore expecting the NTAs of listed private equity funds to outperform listed equity markets by even more as this longer lag continues to feed through into the monthly numbers that are published in December. Now, to just look at how GVF's investments have done in this space. The bar charts here show how the investments GVF made have performed. These returns are net of trading costs, and they're stated in US dollar, which is how we think of the main currency risk in these companies. And just for a bit of context here, Fund B was an investment we made at the beginning of the year. Fund C was made in Q2, and Fund A was made midway through the year. Now, as you can see, they've generated good returns already, and this is over a period much less than a year. So on an annualized or IRR basis, the returns are much, much higher. So in summary, it's played out as we expected so far, and it's been a good experience for GVF. We do think, though, that there's more to come, and we look forward to updating everybody on it again in due course.
Brilliant. Thanks, Mark. I'm glad it all worked out. Okay, so as many of you know, Miles and I just wanted to give a quick manager update at this stage. Our business plan has always been to eventually set up an Australian office of Saudi Capital to complement our London base. In simple terms, there were kind of three drivers for that logic. Miles, I might ask you to talk about the first driver, and I'll talk about the second two, if that works for you.
Okay, sure. I mean, we've been planning for this for so long now. It's strange to run through the original rationale, but I mean, from an investing point of view, and this is no surprise to anyone, Asia's become like an enormously large and important part of the markets in its own right, especially over the last decade, the last 15, 20 years I've been away from London. And a market that's growing enormously, growing much faster than Europe and North America. Over the life, and we invest all around the world. We've got investments in every time zone at any one point in time. Over the life of GVF, probably about a third of our capital has been invested in Asia. And given that the capital markets in that region are a bit less developed than Europe and North America, we probably do a little bit too much of our focus. They're a lot less efficient and can be, for that reason, can be very profitable places for us to invest in. Or to say another way, that means that the third of the capital we've invested in Asia over the life of GVF has generated a good bit more than a third of the profits of the company. So we've always wanted to have an office in the region to allow us to focus on some of these opportunities, especially in this fast-growing market. It's always been a struggle to really do that effectively from the London time zone on its own. So that from an investing point of view, that's always been the driver.
Absolutely. And then there's been two other drivers. The second one, and probably the most important reason, the large majority of our clients are in Australia. And that will always be the case for our business. One of the important elements of running a LIC is effective shareholder engagement. And we've always been hamstrung trying to do that from London. The last 2 years of being in lockdown has particularly demonstrated to us that it's very difficult to run a client business the way you'd like to when you struggle to spend any time with your clients. So that was very important to us. And then I guess finally, the last reason is a personal one. You know, it's no secret that Australia is God's country. I mean, Miles has spent the last 5 years taking me around the entire...
And God's rugby team.
No, well, I mean, let's just calm down there. We've always wanted our children to grow up in the sunshine, and we have a lot of family in Australia. So our plan from a personal level has always been to move when the time was right. And from a business point of view, what we wanted to achieve before we put this plan into effect was we wanted to launch our second and our last fund. This is an offering that is open for large endowment funds that we've been working on for some time. Pleasingly, we have done this now. Our second fund began trading on the 1st of July with a sizable investment from a large Asian endowment. The second key thing was to ensure we had the skill set and the resourcing in London for us to open that second office in a different time zone. And we have that now with Mark Ambrose as a senior member of the team who will run London for us. In addition, we'll be making another junior hire to complement the London team on the portfolio management side. So we really are beefing up London. So we've grown to a level now where it is time for us to make that move to us and set up the Australian office. London will always be Staudi's headquarters. But Miles and I are looking at making a move in about a year from now to Australia to set up that second office. And over time, we would expect to make 1 or 2 hires in Australia as well. There were a few questions on this topic from Mr. Lee Chan, Denzel Griffiths, and also Jim Lord. I'm hopeful that I've answered the questions that you asked. But if you have any follow-up questions that you'd like to ask me, please do drop me a line. And the second thing to touch on in terms of a manager update is just to expand on the point I mentioned earlier, that we've now launched our second and our final fund. As a reminder for all of you, we've always set out that we will cap our strategy at 500 million, 300 of which we will allocate to GVF, and about 150 to our second fund, which we've called SVF. In the world of investment management, a 500 million AUM business is actually tiny. You know, most asset managers aspire to run billions of dollars. But this has never been what has motivated us, and just wanted to reiterate those numbers to you. The new fund offering has been set up, as I said, to cater to large endowment funds. So generally universities and other large foundations, most of whom will be in the US. It's a very similar, SVF has a very similar mandate to GVF, and it has the same headline fees. Given it is mainly for US investors, it will be denominated in US dollars, and it's a fund that is incorporated in the Cayman Islands. The fund also has a $2 million US dollar minimum investment amount. Now, the US dollar fund may be suitable to some Australian investors, and we are happy to talk to anyone who might have an interest in investing in US dollars. We also are considering a friends and family reduction to the initial minimum for GVF, but just to say that the minimum required will still be quite sizable. You know, please message me directly if you have any interest, and we can take things from there. And that probably sums up the manager update. If okay with everybody, we might now move on to the Q&A. And what I'll do is I'll stop sharing my screen, if I can learn stop share, and I'll just put our faces on the screen. So we received in loads of wonderful questions, and I'm very excited to go through all of them. I'm going to start actually with a question for Jonathan Trollope. This came in from Trent Howard, and it was actually directed to the board. So I thought I would ask you, Jonathan, to do the honors. The question is, great to see fund grow, but as each year, part of this has been due to capital raising. When would be a good time to review the fees, base and performance paid to the manager?
Yeah. Thank you, Emma, and thank you very much for the question. The answer from the board's perspective, when I say the board, it's the independent directors, Chris Cuff and myself, is actually very simple. There's an investment management agreement, which was signed in 2014, and is part of the ASX listing, and it discloses the fees in that. That is a legally binding contract on the company with the board. So the board can speculate, do what we like, but the legal reality is that the board has no power to unilaterally vary the fees paid either way. So it's really, the manager is welcome to come to us and suggest any changes, but that's a call for the manager. It's not up to the board to unilaterally impose a changed fee arrangement on the manager. So that's it in a nutshell from the board perspective. Obviously, if Miles or Emma wish to comment, they can. I mean, I do say in my capacity as a shareholder, the fees were disclosed and I see the value that's been delivered over time. And from my shareholder perspective, I'm happy with the fees which are paid, but each shareholder can have their own view on that. Before I hand back to Emma and Miles, I would like to extemporize and add one thing very briefly. Fantastic news about you guys coming out to Australia. And Emma, you know, you and I share a background from South Africa. I went from South Africa to the UK, and the best thing I ever did was come to Australia 30 years ago. So I give you
Oh,
I give you every assurance that, other than possibly your decision to marry Miles, it's the best decision you've ever made. So
Thank
I'll
you,
hand back to
Jonathan.
you
Thanks,
guys.
Jonathan.
Thank you for saying that, because I am nervous. I've lived in the UK for 22 years, and so I have a real love for this place. But we'll be coming back a lot. So
I lived in the UK for 10 years. It was a great time, but we are so lucky in Australia, and you will realize that yourself. I give you every assurance.
thank you.
I actually think most Australians don't quite see how lucky they are compared to the rest of the world. It's a pretty magical situation. But hey, look, just coming back to Trent's question, because this question comes up from time to time, and I don't want to duck it at all. I think, so we're just talking about fees. I think the main thing to keep in mind when looking at fees for us is that we are a very small boutique, and we're trying to do something very different, something that hopefully you can't get from most sort of vanilla investment management firms. As a business, what we do is not very scalable. We're not trying to do what typical long-only funds do, most of whom run many billions of dollars. And in running many billions of dollars, it means they have these enormous economies of scale that we don't have anything like. We totally understand that fees are important, but for this, just to be honest, for the small amount of assets that we run and the need that Emma and I have to attract and keep, the brightest of people who are willing to work all hours of the day, we're never going to be able to run a business model that doesn't charge the fee levels that we charge today. We do something a bit different to most fund management groups, and I'd like to think the results we deliver justify on our proposition, but everyone obviously has to make their own assessment of that. Just to add as a little sort of by note, as Emma said, we have now launched an institutional offering of the fund, effectively talking to some of the biggest and very prestigious institutions around the world, and the fees on that vehicle are exactly the same. We've not had any pushback from those investors and prospective investors on the fees. They see the unique, very resource-heavy strategy that we're running. But anyway, just to sort of add some.
Thanks, Miles. Thank you. No, thank you. Okay, next we have a question from Pete Latham, and I quote, "Miles is seen to be power or knowledge behind the throne and the chief investment officer behind the success of GVF. Although you've just added to your investment team, I think there would be many that would ask, what would happen to GVF, its methodologies, strategies, and continuity if, God forbid, anything adverse ever happened to Miles?" Sorry, Emma, I realize that behind every successful man who alleges he wears the pants in the family, there is a woman who's telling him what color to wear. Miles, I think you have to take that one.
Okay. I find questions like that, Pete, just really flattering, and in truth, far too flattering. One of the really unfair advantages I have of being the face of the investment team is that in truth, I get to take all of the credit from everyone else's hard work, which I'm sure makes us look a bit smarter than we really are. And if you look at our team today, it's incredibly deep. So James, who's not on the call today, portfolio manager, James and I have been working together for 15 years doing this strategy, and he's actually got several more years of experience than I do. He's several years older than me. We don't see a lot of James. He's a bit camera shy, but he's a tremendous asset to the firm, and he's been doing our style of investing for, gosh, at least 20 years. Then we have Mark here today. He's a recent hire for us, but it's a very senior role and has 16 years of experience of his own. And then lastly, we have Emma, who these days is very heavily involved in a lot of our activist campaigns, which is one of the key competitive advantages that we have in the market, where we generate lots of returns. So if you were to look at our investment resources and consider that we're actually only managing about $200 million, you could argue we're almost a bit top heavy. If we're at a large, big, sort of more traditional investment management firm like Fidelity or Perpetual, you'd expect a team like this, a team with this sort of depth of experience, to be possibly running many billions of dollars. So part of that's I guess the personnel side. Apart from the personnel side, where you could almost argue we're a bit top heavy, we have some very sophisticated systems. We're all kind of math geeks. Mark, to his credit, has a master's in mathematics, and we're always adding to these things over time, making the systems bigger and better, doing more and more things for us. At the moment, in fact, we actually have a very talented coder working with us to push these systems harder and further. So if God forbid something ever did happen to me, I have to confess I probably am replaceable. Our processes and systems would outlive me. And with Mark, James, and Emma, there's an enormous amount of depth and experience already in place. That's not to say we sound like to be part of the proposition, but we are very heavily well resourced. And I think, just to come back to that original point, one of the things we should probably work on in the future, I think, is investors see a lot of me, which probably lets me take a little bit too much credit for the work of the team as a whole.
Thanks, Miles. Okay, next up, we have 6 questions from John Thompson, and I might ask Mark the first of these, which is, given that many of our investments are themselves trading at a discount to NTA, what would you estimate the look-through NTA of GDF to be?
Okay, no, thanks, Emma, and thanks, John. I mean, looking at the size of the underlying average discount across our portfolio is quite often quite a seductive thing to do, and we do know that other groups try and use that metric in their marketing stats. The reason we don't focus too much on that on its own is that we don't think it really tells you anything too helpful, and that's for 2 reasons. One is that it's not the size of the discount that's important, but how quickly you can unlock it. And the second thing is that it depends on how much of that discount you can actually unlock. And it's the combination of those 2 last metrics that are the thing we tend to focus on. But to give you the short answer, it's 18%.
Okay, great. I'm going to give you another one. That was so well answered. I'm going to give you another one. This is also from John Thompson. The annual report lists 47 long positions, 16 of which are less than $1 million. Why is this? Given your discount capture strategy, wouldn't we get more leverage by building bigger position sizes? Surely leverage equals returns under a discount capture strategy.
Okay, no, thanks, Emma, and thanks again, John. So our portfolio often tends to have tail investments in it, like the 16 that John's mentioned there. And that's usually for 2 reasons. The first is that it can take some time to build some of our positions up. So some of those names will be ones that we've just started to build, and you're seeing them there just at a particular snapshot in time, and they look small at that point. The second, but probably the main reason really, is that we're often involved in the winding down or liquidation of a company. And when that happens, we tend to get the vast majority of our capital back very quickly. And then there's this small remaining stub that can sort of sit there and take a year or 2 to come back to us from the liquidators. And for that reason, we can have a bit of a tail in there, which is just a feature really of the strategy. But overall, the tail is a small part of the fund, and we run large concentrated positions in high conviction names for the same reasons that you've suggested.
Brilliant. Thanks, Mark. That's excellent. Okay, a question from John that came in, and Jeff, I'm going to ask this one for you. There's 2 actually. The question is, could you or Jeff Wilson please talk about the prospects for future consolidation in the Australian LIC sector and how we can profit from that? And what's the interaction with WAR, if any, so far?
And I suppose if you go all the way back, I mean, the interesting thing about the LIC sector in Australia, it's no different to any other sector of the market anywhere in the world. It goes through periods of expansion, it goes through periods of consolidation and contraction. And the great thing about the stock market is, everyone who's on this call, we all love it, because it creates opportunities. And the reason I met Miles and the team was, really was because, we were invested in an NTA discount play, and I was in London, and I just wanted to, it was an Australian company, and I'd sort of track down these investors, these big London investors, and just wanted to see what their view was of life. We're just a little Australian, so so to me the great thing is, there's always been opportunities. The sector itself, has gone, so the last 6 years has gone through a significant expansion phase. Went from 50 odd LICs to over 110. It went from 20 odd billion to 55, 56 billion dollars. And over the last year or so, it's just going through a bit of a consolidation phase. Now, that consolidation phase, I'm pretty sure, well, there's going to be some more consolidation. I know that because we're going to be involved. I'm not sure. Now that's in terms of Wilson Asset Management. I don't know what the portfolio of, I know as much as you guys as investors. So I'm not sure if GVS is a shareholder in these entities, but there will be more consolidation. In terms of, say, Wilson Asset Management or WAR in particular, we're trying to do exactly, what GVF's trying to do. And I mean, the interesting thing is when GVF listed, it was very easy. We sent a letter out to all our Wilson Asset Management, the WAM Capital shareholders, saying, look, if you want to get exposure to what we do, buying $1 for 80 cents, then invest in GVF. And then the funny thing is when we're doing WAR, everyone's saying to me, you're doing what GVF's doing. And I said, well, hold it. When GVF started, we were explaining that's what we do. So, I mean, there is a lot of space. It's a $55 billion industry in Australia. GVF only have, I'm not sure, you guys can, Miles or Emma and, or Mark and the team can say what percentage of the assets are in Australia. But, GVF's a global player. We would like to, in WAR, do some global plays, but it would more likely be, hey, when Miles and Mark are sort of a full with what they want, and are saying, hey, look, have you ever looked at this? We're already set. Then maybe we'll get a few bones thrown our way. So to me, it's very easy for everyone to coexist. One of the bizarre things is, and this is, you think that because I'm sitting on the board, I know what's in the portfolio, what's going on. I mean, as Jonathan said earlier, there's a management contract, with these guys to manage the money, and that is what they do, and we trust them to do that, and they get paid well because they do that well. Around the time that Blue Sky, they were looking at the old BAF, they were looking at restructuring BAF, and the announcement was made, I think, on a Friday, and I just thought it was appalling, the deal that they wanted to put to shareholders. So I remember ringing Miles that night and saying, look, I think this is terrible, et cetera, et cetera, et cetera. And Miles was saying, hey, look, GVF's got a big position. And like I wasn't, I wasn't aware of that. So to me, there is a great opportunity for us both to buy $1 of assets for 80 cents. And to me, there are a lot of, everyone thinks that we're the only two players. There's a lot of players out there. GVF's looking on the global stage. We're just looking on the Australian stage. So to me, there'll be more consolidation. There'll be more expansion. There'll be more opportunity.
Yeah, I agree. Thanks, Jeff. That's awesome.
Thanks, Jeff.
Okay, I'm going to move on. John Thompson also asked, please explain the rationale behind the assignment fee paid to BIM. And I'll take this one actually, because it ties in nicely. So BIM is an entity associated with Jeff Wilson, and Jeff was, he's instrumental in helping us set up GVF. He underwrote all the costs of the IPO. He was one of our first investors in the company, putting $1 million on day one. And so he's helped us enormously, and especially with the marketing and introducing us and really just getting us off the ground and on the map. He and the WAM family put a lot of time and effort into launching GVF and the success that it's become today. And so the BIM fee sharing arrangement just reflects all of that. It's a fee. We pay part of our revenue to the WAM family to thank them. And it's a normal relationship where smaller fund management groups often do this to get themselves on the map. Just to say, we have a similar arrangement in place for our new institutional fund in the Cayman, not with BIM this time, but with US partners who have helped us get onto the map with regards to the US endowment market. So that explains hopefully that question. And then we have a last question from John, which was, with cash rates as low as they are, is the hurdle for performance fees, 4% plus the 1-year interest rate swap, still reasonable to shareholders. Given the number of LICs paying more than 5% in dividends alone, I'd suggest this is a very low bar that should be revised to reflect today's market conditions. Miles, I'm going to give that one to you,
Okay.
if you don't mind.
Hi, John. No, thanks for the question. A great question, one that requires a bit of a thoughtful answer. So I'll try my best. But I mean, I guess the first point to make is the one I was making earlier, which is finance theory says the lower interest rates go, the lower your expected returns should be. And that's sort of a base assumption of finance. When we set GVF up, we spent a lot of time thinking about this and thinking about what a fair performance fee hurdle would be, one that didn't let us as a manager ever get a free ride, one that set a challenging but hopefully occasionally achievable goal that required us to perform. And the key point to keep in mind when you look at our hurdle is our overall proposition, which is the relatively low risk profile that we take on. And a good example that comes to mind to sort of articulate that is, we have about a quarter of our portfolio today in bonds and debt instruments. We do that because it's a wonderful risk reduction tool. It's a slightly better place to put money than the bank, and because we can find interesting opportunities in that space in the market. But just at a prima facie level, if you're investing in bonds and debt instruments today, the yields you're getting on these things are tiny. 0.5%, 1%, a couple of percent, nothing like the kind of hurdle we have to generate to get to performance fee target. So for us to be delivering the kind of returns we've been talking about, to be delivering that kind of 11.5% figure, and we've talked about before, we have to be unlocking an enormous amount of value just on top of what we're getting from the general market returns. More broadly, in a world of zero interest rates, if you're running the kind of conservative underlying portfolio that we do, you shouldn't be expecting much in the way of returns. And that in essence is the idea behind our performance fee. One final thing to add is that, sorry, I think our son has decided to wake up a little bit early. One final thing to add is that when you look at the performance fee hurdle, it's 4% over cash rates. There's a lot of the
Oh, you've gone on mute, I think.
Sorry, can you still hear me now?
Yeah.
Oh, great. Thanks, Mark. What I was going to say is that on top of the 4% hurdle, we obviously have to make back our management fees and all of the company's operating costs. So in truth, the hurdle gets up to closer to a 6% level. And if you recall earlier, just thinking about Emma was saying that over the life of the fund, the annualized returns that have come from just our underlying market exposure, so effectively the bits of return we don't take much credit for, that's been about 6% a year. So at a high level, we're really only charging performance fee on the excess returns, the returns we've generated in excess of what the market's done, and that's certainly the way it should be. We certainly haven't earned a performance fee in every year of the fund. It's been a challenging target for us. Hopefully that gives some colour.
Thank you. Sorry, one more from John Thompson, and this was: do you plan another SPP? That's a share purchase plan this financial year or next? I'm happy to take this one. The first thing I would say is that we're in no rush to raise or get to that level that we've talked about, that 300 million. The second thing I would say is that we will never do a capital raise unless we're trading at a premium, and we're trading at a small discount at the moment. And the last and probably the most important thing that I'd say about a capital raising is that it's obviously a board decision. For now, my priority is to get us to a healthy premium, which is proving very difficult when Miles and the team keep punching out stellar monthly returns that keep pushing the NTA higher and higher. It's proving a bit difficult to keep up. So no plans at the moment to raise any capital in the financial year. But as I said, if there is a window to raise money and it is in shareholders' interests and the board is supportive of that, then I'm sure we'd look at it, but there really isn't any rush to do anything. Anyway, I'm hoping that we've managed to answer all your questions, John, but if you have any others that you'd like to ask me or ask us, please do let us know. We can also line up a call as well. I'm going to move now on to a question from John Robinson. And he has said, do you hold any bond class equity in the LIC realm? I find it hard to work out in the monthly reports what allocation is there. Also, I read your report on low returns over the next 7 years, and I noticed there is very little cash holding. I presume that is there. I presume that is, anyway, I think what he's saying is, but when do you think you might be prudent to raise your cash level, is what John Robertson has said. Milo, I'm going to give that to you.
Okay. So look, I mean, to answer the question straight up, yes, we do. So normally about a third of our portfolio is invested into debt-like securities. So about normally 30 to 50% of the portfolio is in equities. So in the scheme of an international investor, that's not a lot. And about a third is in debt instruments, and then the rest of the portfolio is made up for sort of the interesting things we find around time. Currently, I'd say about 25% of the portfolio is in bonds or debt instruments like that. And as I was saying earlier, we love investing in that space. We don't expect much, almost any of an underlying return from that part of the market at the moment, but we can still unlock value from them, and it's a wonderful risk reduction tool and often acts as a nice hedge against the equity parts of our portfolio. And even though there's not a lot of see-through yield on this part of the portfolio, it's certainly better than money in cash, where, in a real, after inflation, cash rates are essentially negative. So that's to answer your first part. In terms of, I think your second part was perhaps it might be prudent to raise cash levels. I suspect that's a question about risk management, and we get that question from time to time. We think about managing risk at a portfolio level, and the main way we try and keep our risk profile down is through portfolio construction. I know some people use kind of a barbell strategy where they'll invest in equities or high risk asset classes and then sit on cash to try and bring the overall portfolio down. Our philosophy is really to have all of the dollars we have at work working, and in fact, sometimes we use a little bit of leverage, 5 to 10% of leverage. But then because of portfolio construction, we can still run with a relatively low risk portfolio. The lack of correlation between asset classes is wonderful for construction. And then on top of that, sometimes we use some modest amounts of hedging, but that's not a huge part of what we do. Whether it's prudent to raise cash, I mean, the reason we would, everyone has their own view, but the reason we approach our philosophy the way we do is that, there's basically a negative yield on cash at the moment. So we'd rather be fully invested, picking up some sort of market return, but managing risk in a different way to just invest in part of the portfolio.
Okay, that's excellent. A question from Stan McDonald. Hi, Stan, I can see you there. Good afternoon. He asked, how are the kids?
Well,
so
they're not sleeping.
So one of them is not playing ball, but no, they're great. Thanks for asking, Stan. And Mark, you also have some kids, Molly and Maddie, and I believe
I've got two girls, 10 and a 13-year-old. They're good. Loving being back at school and seeing their friends after lockdown. Just getting ready for school now, actually. So
yeah.
Very good. Thank you.
I think Mark was told not to be too loud this morning by the girls in his house. Okay, then we have a next question from Barry Arthur. Do you feel the market feels unsure of where it's going, and are there headwinds to manage into 2022? Miles, I'm going to give that one to you.
Okay. Well, we spent a bit of time going through how we're seeing the big picture, and if I was maybe just trying to condense that down to hit Barry's question, he's asked it in a much more articulate way than me waffling on earlier. I mean, the simple answer is yes. We've had a terrific run. Fundamentally, we don't think that's sustainable for just because markets can't run that fast forever, but also for where we are in the cycle, where interest rates, we've had the big push from interest rates falling lower. If anything, they're either going to stay where they are or go up. If interest rates fall from here, something else pretty horrible will happen. So I think personally, I think people should be dialing down their expectations for next year. I think they also probably want to think about how much risk they're running in their portfolio. If you're desperate to make 15 to 20% a year, you kind of need to live with the volatility that brings. But that doesn't mean it's easy to kind of construct a really bearish argument, and you always sound a bit clever in the market if you do. And I certainly know there's some commentators out there saying we're due another big correction tomorrow or next week. We don't see any plausible reason for that. We just think it's time to be a bit more moderate in what you expect, and to make sure that you're calibrating your risk appropriately. And yes, to hit your first part, I do think the market feels a bit unsure. Everything was so cheap last year. It was very easy to have a conviction position, whereas today there's a lot less certainty about which way the market will go.
Mm.
We're always a bit relaxed about that because most of our returns don't come from what the market does, and we run with a almost pretty dull market portfolio. But yeah, I think we've certainly seen the best of the returns as of today.
I mean, related to that question, and just to say, Sally, thank you so much. Sally Wojciechowski, you asked a similar question. Hopefully Miles has now answered that. But a related question from Stephen Bembrick, and he has said, you know, how is the fund positioned for a rising interest rate environment? So Miles, maybe you could just talk a little bit about that. We've talked about the fact that, you know, interest rates are at all-time lows. Presumably they're going to rise from here. So,
well, that's, I mean, in essence, that's the debate. That's the argument that's bashing itself out of the market every day. And, you know, on one camp, you have people that say interest rates are going to stay low for the next several years, and that justifies where the market is. In the other camp, you have people saying inflation is going to come roaring back, interest rates are going to go up, and the market will correct. And if that does happen, if inflation does come roaring back and stays roaring back, and interest rates have to follow it up, we should expect a market correction. Again, we're not too concerned about that sort of outcome. We'd be pretty well positioned for that. But one thing to say, I mean, the fact that there's this big debate in the market means that the risk of rising interest rates is one of the known unknowns we have. So we are aware, we can all see that it's a risk, and it means that, you know, Mark Emmett and I and the team can plan for that in our portfolio today. So we've certainly positioned the portfolio to be able to cope with rising interest rates pretty well. It's a little frustrating because it means we give up some returns if interest rates don't start moving up, but it provides a lot of protection in the portfolio. And there's probably three levers we use to do that. One, we have a lot of investment in interest instruments today, but we focus very heavily on floating rate debt instruments, not fixed rate float debt instruments. So what that means is that if interest rates were to start going up, we would benefit from that. We start earning higher dividends, higher coupons from our investments. The other way we deal with that is we have a very short duration on the portfolio, which just means that the trade length of a lot of what we do turns over very quickly. And what you're really worried about in a rising interest rate environment is like long length assets, because they're the most sensitive you can have to interest rates shooting up. And probably the longest length asset you can own is the stock market. Because if you own a share in a company, you basically own the present value of its cash flow out to infinity. Whereas if you own a bond that has a 2-year payback horizon, you've got a 2-year investment horizon. So we still have some equity exposure in the market, in the portfolio, about 40%, but compared to a sort of traditional long-only fund that we might have 100% of investments in the market. If we did see interest rates shoot up, you should expect a nice pullback in the stock market, and we would weather that a lot better than those other sorts of funds. And then lastly, and probably most importantly, what we do, everything we go into has this wonderful margin of safety. So even if markets fall, even if the underlying asset value of what we own falls, we can still not lose money or even make money if we unlock enough value on top of it.
Okay, that's great. Thank you, Miles. So that concludes the questions that we got in ahead of the AGM. What I'm going to do now, and as promised by our chair, is I'm going to go through the chat questions, and then at the end I'm going to ask our company secretary to see if there's anybody who wants to ask a verbal question. If you'd like to ask a verbal question, it's just a case of raising your hand, and then you'll be unmuted and you can speak directly to us if that is your preferred medium. But let's start off with the chat questions. And the first one is from John Tranny. Say what?
Do you want to take that one? I can if you like.
Oh yeah, sure. Do shareholders get consideration to top up their shareholding in a similar way to placement shareholders apart from the SPP?
I think what John's asking is, do you make sure everyone always gets equal access?
Yeah, I mean, yes, just to confirm, John, we have always, any capital raising that we've done, we've always made it available to our existing shareholders first. That's really important to us. And so, yes, the last few we've done an SPP. In 2018, we did a rights issue. And that was a retail rights issue, which meant that it was actually open to brand new investors and brand new retail investors. That was quite expensive, and it's likely to be even more expensive now with all of the new rules that have come in. So, you know, we always like to go the SPP route simply because it's very cost effective. and it allows us to look after our existing shareholders. It also does allow us to do a wholesale placement, usually to wholesale investors, but again, that does exclude new retail investors. Outside of that, the only other ways to top up your shareholding would be to buy shares on the market, or to reinvest the dividends. That's what a lot of shareholders do in order to top up their exposures. I hope that answers your question. We then have a question from Elena. She has said, "Hi guys, question for Miles. There was a small investment GVF made in VG8, yes, that's true, where the manager is faced with weak performance and increasing shareholder pressure. Would like to hear your view on that position." Miles, Mark?
That's actually one of James's investments, so why don't I take that one?
Okay.
Hi, Elena, and sharp eyes, well spotted. I mean, when you look at the proposition like a VG8 and VG1, it's obviously got a lot of attributes, the kind of things we look for. One, a manager that has a really good long-term track record, that has arguably hit a poor patch of recent performance, and two, the ability to invest into their fund at a really attractive entry price. We can be quite light on our feet at times. So we're not a shareholder in VG8 at the moment. We've actually been in and out a couple of times this year, investing when things were sort of extraordinarily wide, and then when we had the opportunity to exit at a much tighter discount, we've taken that. The challenge we have looking at a VG8 is a bit like I think the challenge investors probably had with L1 when it went through a period of poor performance. It's got a long-term track record that's very impressive, you know, a management group that have a real kind of differentiated offering, but it's been a tough performance from an investment point of view, tough ride from an investment point of view for some time now, at a time when market's been going up. So that's probably what's been driving the discount. In terms of VG8, I mean, I'll just share some of our secret sauce. Well, what we've always liked about VG8 as opposed to VG1 is that it's a bit cheaper than VG1. And the low-hanging fruit hasn't really been taken. I mean, one of the really important things about LICs in the Australian market is dividend and yield. Investors really rate that. And VG1 recently announced the dividend policy, which really helped its share price. We would have hoped or expect VG8 to do something similar in the future. And that's really been the main sort of near-term catalyst that we can see in that one. But we're not an investor as of today. That doesn't mean we might not be an investor tomorrow.
Good answer. Okay, Ron. Ron has asked, "Hi Miles, what are your thoughts on a 13.5% increase in China's PPI and rising US CPI? Are inflation fears coming to fruition?"
Gosh, look, the data points are coming thick and fast, right? So that China data point, the big kind of sticker shock, and then overnight we had this enormous sticker shock in the US, where US CPI hit 6%, highest in 30 years. The result was well above anyone's forecast. So there's a couple of things that come from that. One, it feeds a lot of ammunition to the part of the market that's arguing that inflation is about to run away and we're about to go back to the 1970s and interest rates are certainly going to charge up. Well, I guess there is a counter argument to that doesn't get as much press, but I think they are winning the argument. We won't know who wins the argument for probably another 6 to 12 months, and that argument is whether this spurt of inflation now is transitory or whether this spurt of inflation today is persistent. We're going to see these kind of prints in a year's time. And the reason I can say that the people that are more sanguine on inflation not being persistent are winning the argument is that we've seen no reaction in the markets. You had a huge inflation print yesterday. US equity markets kind of took it in their stride. And there's a couple of things underlying the big prints. The obvious ones, energy oil prices have shot up. And then we've had this kind of weird confluence events where we had this big shutdown of the economy. We just kind of put the whole global economy on ice very quickly, and then we've kind of let it rip again. And there's this sort of supply chain pull and push factor that's going on where things will settle down. We will get ships and containers working the way they used to, but in the short term, everyone's been locked at home. They've built up a lot of money and they're fed up and want to spend it all. And we've kind of got this little bump through the supply chain kink we've got to work out. That's not to say that these prints are not worrying. And I guess it comes back to the point I was saying before, if we had to make a bet, we would try not to make bets like this because we don't need to for what we do. But if we had to make a bet, we think it's probably a bit of both. So if these sorts of inflation prints are not going to last, oil prices are not going to shoot up as much as they've done every quarter. Food prices can't shoot up as much as they've done in the last several months, every month forever. But there does seem to be a bit of a change in the way that the economy's been structured. You know, and for people's interest, I think for me the thing that's really stark is coming out of the GFC, the last big crash we had and the last big global recession. There was this real mantra of austerity. We need to sort of live within our means and cut debt budgets and cut public services. And I'm not making a political comment here, I'm just sort of an economist making an observation. So coming out of the last recession we had, the mantra was austerity, effectively, and I'm sure we can all remember that. Coming out of this recession, it seems that that kind of old argument has disappeared. No one's talking about that anymore. And the mantra is growth and spend and not worry about inflation. And that mantra has probably come along because when we came out of the GFC and we were using all these new tools like quantitative easing, everyone was paranoid that inflation was going to run away. And in truth, what's happened a decade on, inflation was too low. We invented all these new tools, printing money, and the press went wild that we had hyperinflation in Zimbabwe and all that kind of stuff. And in fact, inflation turned out to be too low. So what the lessons the policymakers have probably learned from that is that we don't have to worry as much as we thought we did. And because, creating jobs and, quality of life is so important, the risk, I guess, is that this time they go too much the other way and they're too keen to spend and not worry about running in debt. And that might lead to a higher underlying inflation pulse than what we've been accustomed to.
Okay, thank you. Okay, no questions from Lumi. Thank you, Steve, for
Jane Crombie one.
we got a Jane Crombie.
Jane, hi,
Yes,
Jane.
hi. Okay, so Jane has asked, in my investment committee and governance consulting roles, I've seen a rapidly increasing focus on ESG and climate issues for investors and boards, particularly over the last 12 months. How does GVF factor ESG into its decision making? Great question. Mala, do you want to take that? Do you want me to take that?
Why don't we all bounce it around? I'll
Yeah.
start off stealing something from Mark. So when we take these things very seriously, and as individuals, we care about them enormously. But I guess for the investing strategy, and Mark summarized this really well for me once, which was in the world of ESG, the G is really the only thing that matters. If you have correct governance in place, if you're doing the right thing as a principle of your business, then the environmental and the social things will follow. And you can't really get that the other way around. You can't have a wonderful environmental policy if you don't have strong governance, if you don't believe in what you're talking about. Maybe, I don't know who wants to jump in after me, but I'd say for our strategy, governance is the key part of what we do. We go around the world finding assets that are trading too cheap, and they're normally trading too cheap because of some failing in corporate governance. So we come in, fight the good fight, and try and unlock value for everyone and try and improve governance in that process. I don't know if I've stolen all the good sound bites, but do you?
Well, you've stolen masks, that's for sure. Mark, do you want to say anything?
No. The only other thing I'd add to that is that our strategy naturally takes us to companies that are asset backed, and quite often they're pretty diversified, and so they own a lot of assets in a wide range of sectors and different sort of asset classes, and because of that, we can't really kind of apply a very sort of hard and fast strict criteria to what we kind of invest in, but we spend a lot of time understanding what we own, and so we run a high conviction portfolio, which means we have a sort of deep understanding of what those companies own and what they're exposed to. So we can't apply sort of just kind of cookie cutter approach to it all, but it's something we do focus on, and we spend a lot of time looking at our companies to understand what they're investing in. So
yeah, I mean, Jane, that's such a great question, and it was something. We had to answer a lot of questions with our seed investor who came into our second fund, SVF, because as you say, I mean, it just feels as though the whole ESG debate has gone on steroids in the last number of months. What I would say is we're pragmatic about it. I mean, as Miles said, there's definitely a focus on the governance for us. Obviously, that's our entire strategy. I also think that there's a lot of lip service in the industry as opposed to actually doing the right thing. For example, there's a campaign we're currently running at the moment where the governance is shocking, and I noticed that the response that we got back, the official response that we got back from the manager or the PR consultant was specifically the head of ESG. And I thought to myself, wow, so you've got an entire head of ESG, but your governance is so horrendous. So I think that there's a lot of titles, and I think there's a lot of
greenwashing.
Well, it feels to me as though there's a lot of like policies in place and people say that they're doing things, but I'd like to think that we actually are putting our money where our mouth is, and we actually are improving governance around the world. And I feel like that is making a real impact. And also just to say, we actually do sometimes take advantage of the kind of ESG policies that have come in place. For example, recently, Mark had a position where we managed to pick up a really good block of stock because a big institution had decided they didn't want any exposure to the airline industry because of ESG. And so we took that block of stock at a very kind of attractive price. So we're doing, I would say we're doing a really great job on the governance side of things, but we also are looking at the returns of our investors and prioritizing that. So I guess that was where the Queen said she was sick of all the talk and no action. That's right, Rod. That's exactly what she said. Thank you as well for Steve. No more updates from the Lumi platform. I wanted to ask Sushma, can we now open to the floor and ask if any investors want to put their hands up and just talk directly to the team?
Yeah. There's no hands up at the moment.
The poll is closed.
Yes.
Oh,
Yeah.
sorry.
Yes.
The poll is
On the road,
closed.
Chair.
Perfect. Yeah, no, that's great.
But just to finish off, so thank you everyone for making some time and to say we're always here. So no question, big or small is too much. Please email, call, or however you would like to get in touch.
Thanks, guys.
Thank
you
you.
for
Thank you,
everyone.
everybody.
Have a good one. Bye.
Thank you very much. Thanks. Bye-bye.